Welcome back. Well, slightly off the highs, but as far as the mid-cap index is concerned, nothing to complain about. The fall at least has been arrested. The Nifty is up 6 points. We have the mid-cap index sitting with gains of around 400 points. And some of these names, the likes of PNB, which is up around 5%, we have been talking about how banks have made a comeback today. So from the broader markets, PNB is one name that you should be watching out for, up 4.5%. Also something like a SAIL, which is up 5%. We have Tata Power, which is up 4%. Canara Bank 2 higher by 4%. GMR Airports, the other one, which is up around 3.5%. We have Godrej Consumer Products as well, reported numbers just a while back. So that stock also in focus. Of course, we'll get more details on this one. But all in all, have to say that financials, they have made a comeback today. Metals too are doing well in trade, and earnings, they continue to flow in. So earnings reactions is something that we are tracking as well. For now, let's take a look at our MCR Spotlight segment, because we have Mangalore Chemicals and Fertilizers, which is surged in trade after reporting good set of numbers, up around 5% off the highs of the day. But if we look at the profits, they are highest in 13 quarters. Margins are highest in 9 quarters for the company. So revenues have gone up by 54%. EBITDA is up 112%. Margins up 200 basis points, leading to a profit growth of 145%. This is on a YOY basis. Even on a quarter-on-quarter basis, company has reported a profit versus a loss that the company reported in the quarter gone by. So in the third quarter of FY23, they have done an EPS of 6.42 rupees per share, which compares with FY22 EPS of 7.41 rupees per share. So looks like in the next quarter, they will of course be able to surpass the FY22 EPS easily. Considering all the fundamentals as well. Zuari Agrochemicals is up as well in trade today. It holds around 54% stake in the company, and yes, of course. So this is about the stock Mangalore Chemicals and Fertilizers. But of course, we have visuals coming in. We will be having a presser from the CEA who will be talking about the economic survey that was just tabled. We have the details as well. So of course, he'll be the one who will explain and talk about more details as far as this important document ahead of the union budget tomorrow is concerned as well. A lot of things that were spoken about, the GDP growth rate that this survey spoke about. So we will be going to him in just a bit and talk about what they have spoken about in the economic survey as well, and what the outlook going forward is, because they did talk about FY24 real GDP growth, which is seen at 6 to 6.8%, and FY24 baseline real GDP growth, which was seen at 6.5%. So FY23 real GDP growth, according to the economic survey, seen at 7%. So more details on this one, of course, Rima, is something we're watching out for.
Absolutely. But the key number in that was the baseline growth, yes. FY24 GDP growth at 6.5%, yes, which compares with about a 6% growth that we've been clocking in this year. So many of the economists we spoke to said that perhaps this next year's growth rate does look a tad bit more optimistic, considering the global uncertainty that we're currently in. But the economic survey went on to say that domestic demand and capital expenditure pickup is going to be aiding growth, and that has been the hallmark, right, of India's growth over the last couple of quarters. The central government has been spending on capex, and that's been driving growth. But this time, we're also hopeful that private capex is going to see a bit of a pickup. And I think the economic survey made a statement that there are incipient signs of private capital formation, which are now visible. On your screen is the Chief Economic Advisor, V. Anantha Nageswaran. He will be addressing the press conference in moments from now. Before that, some photo ops currently underway. So what went into the state of the economy for 2023? What were the key factors when they decided to come out with their GDP growth, what they expect in terms of CAD, what were the key hypotheses, the assumptions made, will be revealed in greater clarity. Today, remember, was day one of the budget parliament session. At 11 o'clock, the economic survey was tabled, and tomorrow, Nirmala Sitharaman will be presenting the union budget. Ahead of that, the spotlight has been taken over by the Adani Group stocks, but tomorrow, once the Adani FPO closes today, and there are all signs that the FPO is going to sail through, the spotlight is firmly going to shift to the budget. So we're still awaiting for the address from the CEA advisor, Anantha Nageswaran. For the markets, let's just quickly do a check while we await the press conference to begin. It's all about the mid-caps. And okay, I think it started.
Good afternoon, everybody. Can you hear me well? So we just spent 1 month of 2023, so you still have 11 more months to go. So I wish you all a very happy and healthy rest of 2023. This morning, we had the International Monetary Fund release its World Economic Outlook update. And they maintained India's GDP forecast or estimate for current financial year at 6.8, next financial year at 6.1, and importantly, for 24-25, they kept India's real GDP growth forecast at 6.8%. So they show an acceleration of India's GDP after a slight dip which they estimate for the next financial year. In fact, the presentation today is going to focus on this aspect, that India's GDP growth is poised to do better in the remainder of this decade, and that is the focus of this economic survey itself. Okay. Not moving. Mm-hmm. देखिए सर It's frozen.
Okay, facing some technical issues before he addresses the press conference. Let me quickly revise what the Economic Survey 2023 had to tell us. FY24 baseline GDP growth, real GDP growth seen at 6.5%. Nominal GDP growth will be seen at 11%.
Let you admire the cover slide for a bit longer than it needed to be. So, what are the key messages, as I mentioned in the initial remarks? Why is the economic growth going to perform better this decade, remainder of the decade? And what the reforms of the last 8 years have done to make sure that happens? And beyond 2030, what will be India's medium-term growth magnets? And finally, as we look ahead to 2047, what else and what more we could do to realize India's full potential in Amrit Kal? And if you look at the, is it moving properly on the screens? Okay, thank you. The survey looks ahead to the medium term because the pandemic response and recovery phase is over. In fact, Chapter 1, the title itself says, State of the Economy, Recovery Complete. And therefore, after a long time, we have banking, non-banking and corporate sectors with healthy balance sheets, and they are ready to borrow and lend and invest. So we don't have to speak about pandemic recovery anymore. We have to look ahead to the next phase of India's economic growth process. So why is economic growth going to be better this decade? In order to look ahead to the future, we always have to first look back at the rearview mirror. Let's rewind the tape a little bit. What happened in the first decade of the millennium was a lot of optimism about BRICS economies. By 2002, balance sheets were lean and mean. Companies were willing to borrow, invest, banks were willing to lend. So leverage ratio in the corporate sector and in the overall non-financial private sector rose very sharply in the first decade. And it got to the point where the credit to GDP ratio in actual terms was much higher than the trend in the first decade of the millennium. That is what you see. The middle hump is basically actual credit GDP ratio was well above trend, and it persisted for a long time. And because it was quite well above trend and also lasted longer, naturally it led to a period of excess borrowing and excess lending, and the second decade was a payback time. So India went through a classic financial cycle, credit boom and credit bust, and this is not something new for the world. Every time you go through a financial boom and bust, it does leave its impact on economic growth, and that is what happened to us, especially in the second half of last decade. And you can see this here. Look at this chart. From 1980 to 2000, the bank credit to GDP ratio was roughly around between 25 and 30%, and then it jumped from 25 to 55, 60%, and spent the second decade of this millennium hovering in that range. This is the digestion process. So there was massive expansion. Remember, this is a ratio. GDP went up, but the bank credit expanded even more than GDP growth, and naturally, such a big spike within a space of 10 years, what we could not achieve in the previous 20 years, naturally had to lead to some kind of a credit indigestion problem, which had to be adjusted in the second decade. And now, that process of indigestion that has been sorted out, and the balance sheets are repaired now, and banks' non-performing ratio, whether it is scheduled commercial banks in general or public sector banks, they are lower now. And you can see that also banks have done so partly through recapitalization, raising fresh equity, and also through higher provisioning. So bank balance sheets are repaired, and that is why you see that in the credit growth picking up. You look at credit growth across sectors: agriculture, industry, services and personal sector, housing loans and car loans, etc. The growth rate is now sustainably above double digits. And this is a sign that this is what we were missing towards the second half of last decade because of balance sheet issues. So quickly summarize exactly what happened was 2005 to 12, credit boom that led to balance sheet stress later, face of a higher non-performing assets due to past forbearance. And then, by the time we could repair, just want to leave one statistic with you. The non-financial private sector leverage ratio, debt to GDP, went up by 40 percentage points in the first decade, from 2000 to 2010. And from 2010 to 2018, it came down by 30 percentage points. And by 2018, that was kind of done, it had bottomed out. But before we could start expecting corporates to borrow and banks to lend, came the collapse of IL&FS and some housing finance companies. And by the time we got a grip on that problem, came the pandemic. That lasted 2 years. And then 2022, we had the commodity price shock and synchronized monetary policy tightening after a very long time in the developed world. So it's a case of balance sheet stress followed by successive one-off exogenous or external shocks that have basically prevented the impact of economic reforms pursued by the government on economic growth. We would have seen the results already, but for these successive one-off shocks on the back of a fairly large credit boom that turned into a bust. The reforms of the last 8 years, which I just now mentioned to you, basically spans multiple dimensions. It is not purely about economic reforms for higher growth. It is also about inclusive growth, financial inclusion, banking cleanup, the creation of the digital public infrastructure, which I think I'm going to talk about a bit later as well, and contribution to healthy India, ease of living, and continuing on to the next slide, physical infrastructure creation, facilitating investments, transparent taxes and tax administration, ease of doing business, and farmers' welfare. So broadly speaking, about 10 areas we have covered here. These reforms were happening even as the banking cleanup was going on. And this episode between 2014 and 2022 has a lot of parallel to what happened between 98 and 2002 as well. Then, as now, the banking system was coming out of an NPA crisis, and there were sanctions on India after the nuclear device was tested in Pokhran in 98, and deleveraging was getting on in the banking and corporate sector. There were 2 successive droughts. The technology boom ended, internet boom ended in 1999-2000, and the US recession followed. 9/11 happened. But amidst all these shocks, interest rates were deregulated, privatization was pursued vigorously, And the first foundations of the insolvency and bankruptcy regime was laid with the asset recovery mechanisms. The FRBM Act was introduced, and today's digital infrastructure, which we talk about, the foundation for that was laid with telecom reforms in that era. But obviously, there is a lagged effect for these reforms to show through in the data because underlying conditions had to turn favorable. We talk of public digital infrastructure. Okay. I think it's not enough if I just look at the screen, right?
Okay, so we will get more details on that one. Technical issues, of course, there has been a pause there, but of course he's spoken about a lot of things apart from what the economic survey spoke about, talking about credit growth sustainability being very high, and this is something that was missing earlier because of stressed balance sheet as well. They are talking about financial inclusion, bank reforms, transparent taxes, ease of doing business, and farmer reforms as well, which they will be focusing on and have been focusing as well as a government. They don't want to talk about pandemic recovery anymore, but okay, it has started back.
Joan Robinson said in the 1960s about India, whatever you say about India, the opposite is equally true. That's what she said. And so anyway, the parallels to the 1998-2002 period, to this period is that even as a crisis was being addressed, economic reforms were pursued, and when underlying conditions turned favorable, the lagged effect of reforms showed through. That's exactly what is reflected, for example, in the IMF forecast, and that is what we expect in the medium term as well. The lagged effect of the reforms will show through because in the last several years, the full effect of the reforms could not be felt in the data because of successive one-off shocks. And that's why we talk about the medium-term growth magnets for the economy. The entire philosophy of economic management revolves around making it easier for people to pursue their economic activities in individual lives or for businesses, and ultimately leading to efficient resource allocation and, more importantly, enhancing the potential of the economy to grow at a higher rate. And that includes, obviously, it is an indicative list and not a complete list, agricultural growth, a trust-based governance model, public goods for inclusive growth, both infrastructure, digital and physical, and many other things which will come under that, involving the private sector, and more importantly, managing the energy transition, reducing our dependence, and also addressing climate change issues as well. It is not about the government doing things for the people, but also involving people in the process. Everybody is a participant in the development process. That is why it is Sabka Saath, Sabka Vikas. So it is not just a government being an enabler, but government being a partner to economic growth. First, we deal with one of the pillars, agricultural growth. Thanks to many of the initiatives which you see around this slide, what you see is that the share of private sector investment or capital formation in agriculture has reached a level which is higher in the last 12 years. Since 2013-14, 9.3% of overall gross capital formation is contributed by the private sector in agricultural sector. And it has been facilitated by the creation of the Agricultural Infrastructure Fund, a national agriculture market which has linked farmers with direct buyers, FPOs which take into account organic farming options as well, and more importantly for the farmer, income support as well as risk management through crop insurance.
All right, that's the word coming in from the Chief Economic Advisor, Mr. V. Anantha Nageswaran. He spoke about a lot of things, including what they are looking out for as far as the economy is concerned. They are saying that we are back, the recovery is back on, and the pre-pandemic era levels are being seen. Credit growth to MSMEs remarkably high, over 30.6% in the Jan to November 2022 period. And he also speaks about how credit growth has been sustainably high right now, will be a brisk credit growth in FY24 if inflation declines and credit costs don't rise. So these are some of the takeaways from his presentation as well. As far as our own markets are concerned, of course, that continues to be in focus yet again. Nifty is the one which has seen a sharp decline from the highs yet again, a 40-point downtick here. And banks, they also continue to be in the focus right now. So the bank Nifty, which was higher in trade and has continued to do that, has also come off substantially from the highs. A 120-point uptick is what we are seeing. But as we can see, substantially off the highs of the day. We'll do one thing, we'll take your leave on this edition of Midcap Radar and all the updates, but stay tuned. Closing bell comes up next.